Welcome to Wealthion. I'm Adam Taggart, founder of Wealthion, here with a short explainer video to convey the seriousness of just how quickly the economic outlook is worsening for regular folks like you and me. I released an earlier video back in April showing how consumers were starting to buckle under the big jump their cost of living has taken over the past year. I warned that the risk of a recession was rising, and that if one does occur, things would likely get a whole lot worse for households. When the video came out, it contradicted the confidence projected by our authorities and by the media. But now, less than just 2 months later, many of them are suddenly voicing the exact same concerns. Perhaps none so loudly as Jamie Dimon, the CEO of megabank JP Morgan, who issued a warning advising investors to brace themselves for, quote, an economic hurricane. In today's video, I'm going to dial through the latest data on how the situation for the consumer continues to deteriorate, including several emerging headwinds that were hardly on the radar until recently. As always, the goal here is to keep you well informed so that you're able to take prudent action today to reduce your exposure to what's ahead and possibly even position yourself to prosper from it. Okay, first off, a reminder. Consumer spending makes up nearly 70% of GDP. Where the health of the U.S. consumer goes, so goes the U.S. economy. And right now, in a nutshell, the U.S. consumer is getting squeezed. Inflation continues to run hot, raising the cost of living to painful levels for essentials like food, rent, and gas. While at the same time, the cost of capital is rising. This impacts everyone getting a mortgage, an auto loan, or using a credit card to buy groceries. They can afford to buy less because the debt they're taking on now costs more. Mortgage rates have nearly doubled since last summer. Auto loan rates are spiking dramatically since the beginning of this year, and credit card rates are expected to hit an all-time high later this year. These interest rates on all these types of debt are poised to go even higher as the Federal Reserve continues along its declared path of more than doubling the federal funds rate by the end of 2023. So, we've got the twin weights of higher cost of living and higher costs of capital pressing down on households. Now, that would be okay if household wages were rising at the same rate, but they're not. While it's true that wages have been on the increase this year, they're not growing nearly fast enough to keep up with inflation. In fact, real wages have fallen over the past year in nearly every sector of the economy, making real disposable household income now lower today than it was before the pandemic hit. So, in a nutshell, households are falling behind. Their take-home pay is buying less, and relief anytime soon just isn't on the horizon. And actually, the horizon is darkening further with additional storm clouds. Let me quickly point them out. First, household financial portfolios have taken a hit this year. So far, 2022 has been one of the worst years ever for both stocks and bonds. As at the time of this recording, since the start of the year, bonds are down around 10%, the S&P is down 19%, the Nasdaq is down 28%, and Bitcoin is down 39%. Those are substantial losses, and they make consumers feel less wealthy and therefore less confident about spending money on discretionary items. But given that financial assets are disproportionately owned by the wealthy, what really has the potential to put a wet blanket over consumer spending enthusiasm is falling housing prices. And that's one of the new headwinds in this story. Home prices have been steadily rising over the past decade and went into overdrive last year, increasing 19% in 2021. The narrative has been that housing prices are unstoppable. That limited inventory, a new mobility unlocked by the work-from-home movement, and growing demand from both small and large investors would be more than a match for any increase in mortgage rates. Well, that narrative is breaking fast. So fast that Moody's Analytics chief economist Mark Zandi just declared that the housing market just slid into a full-blown correction. Specifically, he says, The housing market has peaked. Everything points to a rolling over of the housing market. In terms of home sales, they're falling sharply. Housing demand is coming down fast. Home price growth will go flat here pretty quickly. We will see home price declines in a significant number of markets. And that's exactly what we're starting to see. Active listings have suddenly spiked as buyers become scarce. Closed sales have fallen for the past 9 months in a row, and the trend is only getting worse. And compared to last year, the percent of homes selling at a reduced price has positively exploded. So, looking at our checklist, we have consumers feeling poor because their wages are buying less, they can afford to borrow less, their financial portfolios have taken a painful sting so far this year, and now their home, typically the biggest asset for a household, looks like it's about to fall in value. All that together certainly should influence folks to curtail their spending going forward. And remember, as consumer spending slows, the economy slows. But I'm not done yet. There's another powerful suppressant to consumer spending that's only now just being realized, and that's jobs. Similar to housing, all we've been hearing about the jobs market is that it's too good. Companies can't hire enough workers. People have been quitting and retiring by the millions. At last month's FOMC press conference, Fed Chair Jerome Powell couldn't stop mentioning how there were 2 job openings for every applicant. Take note of his fixation here, as it's very important. Powell is being very specific that he's out to tame inflation by, quote, reducing demand to the point where job openings move down substantially. Essentially, he's declaring war on the jobs market. Now, of course, he's not using those exact words as they're inflammatory, but he's being clear he wants to dampen consumer purchasing demand to the point where spending falls far enough that companies reduce their hiring aspirations. The danger here, of course, is that just like the Fed spent years courting inflation and then suddenly got way more than it wanted, the Fed may engineer the same outcome here with job destruction. The Fed, which has a long history of policy errors, by aggressively hiking rates and starting quantitative tightening, is putting the brakes on the economy right at the same moment that consumers are already tightening their pocketbooks for the reasons I mentioned earlier. Economically speaking, this may be like tossing an anvil to a drowning person. As spending slows, companies first freeze their hiring, then engage in cost-cutting measures, and then ultimately and only then resort to layoffs. But in fact, we're seeing all 3 of those happen right now. Major retailers like Amazon, Walmart, and Target are reporting that consumer demand hasn't been as strong as they expected, and now inventories are piling up. And as a result, they find themselves overstaffed. Hiring freezes have been announced recently at companies like Microsoft, Nvidia, Lyft, Snap, Uber, Coinbase, Salesforce, Meta, Twitter, and Tesla. And even though it's early, layoffs have been picking up substantially. This tracking chart I've frequently been showing of layoffs in the tech industry shows that layoffs have suddenly exploded back to levels last seen in July 2020 when we were putting the world economy into lockdown. And note that in the chart here, Q2 isn't even fully over yet, so that number will likely go higher still. Okay, so going back to our checklist, consumers are now facing a rising cost of living, rising borrowing costs too. They've got declining real wages, they've got financial portfolio losses, a correcting housing market, and now the fear of possibly losing their job in a coming recession. Folks, this does not bode well for the future of consumer spending. And the faster households tighten their budgets, the faster the next recession will likely arrive. Is it any surprise that consumer confidence is currently in the toilet? It's at lows that we've only seen previously at the depths of recessions. Is it also a surprise that the personal savings rate is at its lowest level in 14 years? Or that increasingly strapped consumers are financing more and more of their living expenses with credit cards? Look at how ferocious the growth in consumer credit has been over the past year. All right, wrapping things up here, the big takeaway from all these charts and headlines is that the main driver of GDP, consumer spending, looks set to slow faster than most expected, or possibly even imagined. And while this is happening, the Fed is actively and aggressively pursuing policies to dampen the spending even further. And all of this comes at a time when the economy is already fast slowing. Remember, US GDP dropped from a robust 6.9% in Q4 all the way down to a negative 1.5% in Q1. And current Q2 GDP projections by the Atlanta Fed have been recently downgraded to an anemic 0.9%. So the economy has net contracted so far in 2022. What does this all mean? It means that while we can't say for certain, the odds of a recession, accompanied by further asset price declines in the financial markets, lower housing prices, and job layoffs, are uncomfortably high at this point. Now look, I'm not trying to scare or depress you with this message, but I am prompting you to take prudent, preemptive action now to reduce your vulnerability to what likely lies ahead. Make sure you've got 3 to 6 months emergency savings built up. Position your financial assets defensively should markets fall further from here. And if you need help with that, talk for free to one of the financial advisors that Wealthion endorses by filling out the short form at wealthion.com. And if you work for a paycheck, take steps now to make yourself less susceptible to being laid off or to be better positioned to rebound in case you are. For guidance on how to do this, read our free layoff survival guide at wealthion.com/layoffs. Sit down with your family members and close friends and discuss how you can best support each other should hard times strike. Can you help each other financially? Maybe can you share resources with one another? Look, recessions are a natural part of the economic cycle. As such, we shouldn't live in fear of them, as they provide the gateway to the next upcycle in prosperity. But while we shouldn't fear them, we should respect their cleansing nature and do our best to avoid becoming unnecessary collateral damage to it. So, use this video as your prompt to get your preparations in place. And feel free to share it with anyone in your life who you think would benefit from a wake-up call like this. And for those of you who want to stay on top of the situation as it unfolds in real time, well then just keep watching Wealthion, as I'll keep interviewing the world's top experts on money and the markets every week here to keep us all as updated and informed as possible. With that, please help support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Thanks for doing that, and thanks for watching everyone. I hope this video has been useful.